Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Workday.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we really jump into today's analysis, we should give a quick shout out to StockOracle.
Right, yeah. StockOracle is an AI-aided stock research platform. It's, not financial advice or a trading signal service, and it doesn't provide real-time market data.
Exactly. We do have a special 14-day trial link right down in the description for you. Just a heads up, it is an affiliate link, which means the channel may earn a commission at no extra cost to you.
Yep, and please remember that StockOracle's AI insights and valuation estimates, well, they can be incomplete or just wrong. So always make sure to verify any important facts yourself.
For sure. Okay, so let's get right into it. Imagine pouring your morning coffee, checking the market, and seeing that a mature, deeply established cloud software pioneer has suddenly surged 17.78% in a single day.
Yeah, we're talking about a massive $31 jump. That puts the stock price up to over $206 a share.
Which is just, it's kind of crazy. That kind of sudden price action forces you to pay attention, right? Regardless of whether you actually hold the stock or not.
Oh, absolutely. Seeing a move of that magnitude in a large cap, established tech company is incredibly rare.
It really is. It's almost like finding out your quiet, super practical, reliable friend just showed up to dinner driving a brand new neon red Ferrari.
Right. Everyone at the table suddenly wants to know exactly where the money came from.
Exactly. And more importantly, if they can actually afford the car. So today, we really want to figure out how Workday bought the Ferrari. We're going to look under the hood at their day-to-day financial health, examine this wild technical momentum, and untangle the massive multi-billion-dollar rumor driving the whole thing.
Because the underlying question we have to answer for you is whether this current price reflects an unstoppable, fundamentally sound business, or, if it's just a speculative bubble that's stretched entirely too far.
Yeah, and the data presents a really complex narrative.
Yeah.
Let's start with the baseline, right? Before we focus on the Ferrari in the driveway, we need to know what the daily commute looks like.
Exactly. How is the business actually performing day to day when the news cameras are off?
Because on paper, the engine room seems incredibly strong. In the quarter ending April 30th, 2026, they generated $2.542 billion in revenue.
Which is a solid 13.5% year-over-year growth rate.
Yeah.
That's a really respectable clip for a company of this scale in most standard corporate contexts.
Right, and the bottom line looks even better. The net income for that same quarter was $222 million.
Oh, wow.
Yeah. They literally tripled their net income from the $68 million they reported in the exact same quarter a year ago.
Tripling net income is huge. And their gross margins are sitting at, around 75.7%?
Yeah, nearly 76%. Plus, operating cash flow is strong at $696 million, giving them a free cash flow proxy of roughly $616 million.
So that paints a picture of a company that is highly efficient at extracting profit from its operations. When you have gross margins hovering near 76%, you're demonstrating the classic scalability of a mature software-as-a-service model.
Right, because the cost to deliver their software to, one additional customer is practically negligible.
Exactly. Most of that revenue drops straight down to the bottom line once their fixed costs are covered, which perfectly explains how they managed to triple that net income.
Okay, but let me play devil's advocate for just a second. If their margins are that impressive, what about the debt?
Good question.
Because they have about $568 million in cash and cash equivalents, but their total long-term debt is almost $3 billion. Doesn't that debt load, kind of eat into the actual cash they can play with?
Well, it is a factor you have to monitor, absolutely. But you really have to weigh it against the total balance sheet. Their total assets are over $16 billion against about $9.4 billion in total liabilities.
So the structure is sturdy enough?
Yeah, it's sturdy enough to handle the debt servicing, especially when they're generating nearly $700 million in operating cash flow in a single quarter.
Okay, wait, I need you to back up then. If they have a 13.5% growth rate, they're tripling net income, and the balance sheet is sturdy, why in the world is Morgan Stanley slapping an underweight rating on them with a $145 price target?
It does seem contradictory.
Right. They specifically cited growth and margin concerns. That just seems totally backwards for a company that just tripled its profit.
What's fascinating here is The broader context of software tech valuations. You have to separate absolute performance from, like, historical market expectations. Yes, a 13.5% trailing 12-month growth rate is solid in isolation. If this were a legacy automotive manufacturer or a retail chain, Wall Street would literally throw a parade.
Right, but for a cloud pioneer.
Exactly. For a cloud pioneer, that 13.5% actually signals a deceleration compared to the historical growth rates investors are used to seeing from them.
So it's the classic tech trap. You're growing, but you're not growing fast enough to justify the premium the market has historically placed on your stock.
It's the law of large numbers catching up with them. When a company scales to nearly $10 billion in full-year revenue, maintaining historical 20 or 30% growth rates becomes mathematically grueling.
Yeah, you have to add billions of dollars in brand new sales every single year just to hit the same percentage.
Exactly. And that deceleration is exactly why analysts like CLSA have also initiated coverage with an underperform rating.
Yeah.
The core concern isn't that they are losing money, it's that the top-line engine is losing its thrust.
Because the market pays for future growth, not past achievements. Okay, so the fundamental reality is a highly profitable but slowing company. But a deceleration narrative absolutely does not explain an out-of-nowhere 18% price explosion.
No, it certainly doesn't.
To explain the $31 upward jump, we really have to look outside the balance sheet. Because the real catalyst here wasn't an earnings beat or a sudden burst of new enterprise customers.
It was a massive, unconfirmed market rumor.
Exactly.
And, the market is entirely narrative-driven in the short term, and this is a blockbuster narrative.
Right.
Reuters reported that the massive private equity firm Silver Lake is in talks to acquire the company.
And we are talking about a potential valuation of around $43 billion.
Yeah, $43 billion.
Yeah.
If this were to materialize, it would be one of the largest tech buyouts in history.
That is an enormous number. And what's super interesting is how the broader macroeconomic weather aligned perfectly to turbocharge this rumor.
Oh, the timing was perfect.
Right, because right as this Silver Lake news hits the wires, we get cooler wholesale and consumer inflation data.
It created an absolute perfect storm for the stock. Softer inflation eases the pressure on the Federal Reserve regarding interest rates. And as we know, lower interest rates make financing a $43 billion buyout significantly cheaper for a private equity firm like Silver Lake.
Oh, that makes total sense. So you combine a softer macro outlook with a credible tech buyout rumor, and the rising tide dramatically amplifies the jump in this specific stock.
Yeah, and the S&P 500 was hitting record highs around the same time, providing incredible tailwinds overall.
Right, and the technical surge resulting from this is just staggering. The stock blasted past all its simple moving averages, or SMAs.
It really did.
Just to visualize this for everyone, think of moving averages like a rubber band attached to the current price. It keeps the stock tethered to its historical reality. But right now, the price is trading 43% above its 50-day moving average of $144.16.
Which is massive.
Isn't that rubber band stretched dangerously tight?
Oh, extremely tight. If we connect this to the broader principles of technical analysis, the alignment of the short-term averages shows a violent, sudden momentum push. The 20-day SMA is sitting at $161.33.
But the longer-term trend hasn't caught up, right?
Exactly. Look at the 200-day moving average, the true long-term trend indicator. It's lagging way behind at $162.85. The surge is purely speculative and event-driven.
And the relative strength index, the RSI, reflects that momentum too. It hit 82.09.
But, for someone who doesn't stare at technical charts all day, how does the RSI actually measure that momentum? And why is 82 considered such a massive outlier?
So the RSI is essentially a momentum oscillator. It measures the speed and magnitude of recent price changes on a scale of 0 to 100.
Okay.
It calculates the average gains on up days versus the average losses on down days over a specific period, usually 14 days. When a stock goes up consistently with very few down days, the math pushes the RSI much higher. So it's basically a speedometer for buyer enthusiasm.
That's a great way to visualize it, yeah. Conventionally, a reading over 70 indicates a stock is overbought, meaning the price has risen too far, too fast, and a pullback is statistically likely.
And they hit 82.
Right. Pushing past 82 is deep into extreme overbought territory, It mathematically confirms that buyers rushed in entirely on the headline, completely disconnecting the price from the fundamental baseline we just discussed.
Which means if that rumor turns out to be hot air, there is absolutely nothing catching this stock on the way down. The rubber band is going to snap violently back to those moving averages.
Without a doubt.
So let's look at the bear case, because there are some glaring red flags hiding behind all this momentum.
The single biggest, most immediate risk is the nature of the Silver Lake talks themselves. The reporting clearly states these are just preliminary discussions. There is no definitive agreement on the table right now.
Yeah, and private equity talks at this scale aren't like buying a house. They are like merging two massive bureaucratic governments. Until the ink is completely dry, a deal can fall apart over a single spreadsheet error or just a slight disagreement on valuation.
And if those negotiations collapse, which happens frequently at a $43 billion scale, that dangerously tight rubber band is going to snap. The overbought stock could violently retrace its gains, dropping right back down to where it was before the rumor even leaked.
Right. And speaking of hot air, let's talk about the people who actually know what's going on inside the company. The insider trading data is wild.
It really is an eye-opener.
According to the data, there have been 80 open market sale transactions by insiders. They have dumped nearly 1 million shares. And how many open market purchases have there been?
Zero.
Zero. Not a single one.
This raises a really important point about market psychology and how executives view their own company's valuation.
But wait, I mean, I know it's totally normal for tech executives to sell stock. They get compensated in equity, so they sell to pay taxes or diversify their portfolios.
Sure, that's standard.
But zero purchases across 80 transactions. If you knew your company was about to be acquired at a massive premium, wouldn't you pause your selling? Or maybe even buy more? Doesn't that send an incredibly loud signal that even the insiders don't see massive long-term upside at these current price levels?
It absolutely does. The complete absence of buying is a huge cautionary tale. And when you connect that behavior to the company's valuation, the insider caution makes perfect sense. The stock is currently trading at a trailing background, price to earnings, or PE, ratio of 51.12.
Break that down for me. I know that means investors are paying $51 for every $1 of earnings the company generated over the last year. But how does that compare contextually? Is 51 historically high?
Well, the broader market average is typically somewhere around 20 to 25 times earnings. So at a 51 multiple, expectations are sky high. You are paying a massive premium for future perfection.
And we already established their growth is actually decelerating.
Exactly. So you have a high valuation multiple colliding with slowing growth.
Meaning there's zero margin for error baked into that price.
None. If the buyout fails, or if growth slows even a fraction more than Wall Street expects, the floor could drop out incredibly fast.
Yeah, and let's not forget the recent history here. Before this Silver Lake rumor acted as a defibrillator, the stock was really struggling. Over the previous 52 weeks, it had a negative 18.32% return.
It was under severe pressure.
And on top of the growth concerns, there are lingering legal and regulatory risks regarding claims of AI-driven hiring bias. We don't have all the specific legal details on the case, but anytime you mix the terms AI and bias in an enterprise software environment, corporate compliance departments get very nervous.
Oh, absolutely. It introduces a massive friction point for the sales team.
Yeah.
It's a classic asymmetric risk profile right now. The upside is heavily dependent on a single unconfirmed binary event, the Silver Lake buyout.
Right.
But the downside is weighted by decelerating growth, stretched valuations, insider caution, and those operational risks you just mentioned.
So if you are looking at the stock, watching this precarious tug of war between the buyout hype on one side and the underlying growth concerns on the other, what exact dates do you need to have circled on your calendar right now?
Well, the most immediate reality check will be the imminent fiscal Q2 earnings announcement, which is scheduled for August 27th, 2026.
Okay, so that's coming up fast.
Yeah, this is the moment of truth for those Morgan Stanley and CLSA downgrades.
Yeah.
Will the company show that revenue is actually re-accelerating, or will the numbers validate the bears' concerns about slowing growth?
That August 27th date is massive, but there's also a major product and marketing push coming up. In mid-October 2026, they are hosting their Workday Rising conference. And there's a heavy focus on two things: their learning platform, powered by a company called Sanana, and something called agentic AI.
Ah, yes, agentic AI. That is the multi-billion-dollar buzzword for the entire software sector right now. Everyone is trying to pivot to it.
Let's break that concept down for a second because we hear the acronym AI thrown around by every single tech company constantly. Think of regular AI like a very smart intern, right? They can graft an email or summarize a long document if you specifically ask them to.
Sure.
But agentic AI, from what I understand, is like hiring a proactive manager. They notice a supply chain delay, draft the email, send it to the vendor, and update the accounting software, all without you having to ask. It takes independent action to solve complex workflows.
That is exactly the promise they are trying to sell to these massive enterprise companies. And it sounds incredibly powerful, particularly for human resources and finance software where workflows are notoriously complex.
Right.
However, from an investment standpoint, the conference in October is a highly speculative catalyst. We don't really know how quickly enterprise customers will actually adopt it, trust it, and most importantly, pay for it.
Yeah, you are right to be skeptical of the buzzwords until they show up as actual revenue on the balance sheet. It could just be shiny marketing designed to distract investors from those Morgan Stanley growth concerns. But there is one catalyst here that isn't just a buzzword. It's an actual regulatory milestone.
The FedRAMP moderate authorization.
Yes, for their adaptive planning tool. For those who aren't navigating government procurement all day, what does that actually unlock and why is it so hard to get?
This is a vital distinction to make. Unlike the speculative AI conference, the FedRAMP authorization is a confirmed, tangible gateway to revenue. FedRAMP is the rigorous, standardized security assessment the U.S. federal government uses for cloud software.
And it's not cheap to pass, is it?
Not at all. Achieving moderate authorization requires overhauling data architecture, undergoing strict compliance audits, and spending millions of dollars in upfront investment.
So it's an economic moat.
It's a massive moat.
Yeah.
Most competitors simply cannot afford to jump through those regulatory hoops. By achieving this authorization, they eventually been given the security clearance to sell the specific planning software directly to federal agencies by 2027.
And the federal government is a client that never bounces a check. Plus, once they install a massive software system, they almost never switch vendors. It's deeply sticky revenue.
It is a highly lucrative public sector expansion. It provides a very credible counterbalance to the concerns about slowing enterprise growth because it's actual fundamental progress rather than speculative hype.
All right, well, we have pulled on a lot of threads today. Let's bring this all together so you can factor this into your own research. Taking everything into account, the fundamentals, the technicals, the rumors, the risks, the overall bullish score from the platform comes in at a 6.
Which gives it a firmly neutral stance.
Right.
And that neutral stance encapsulates the tension perfectly. On one hand, you have a company whose profitability is drastically improving. Tripling net income is undeniable, the gross margins are stellar, and the FedRAMP authorization secures a very real future growth vector.
Yeah, the business itself is not fundamentally broken by any means.
But on the other hand, the current price action is a dangerous high-wire act. That 17.78% surge is relying entirely on the Silver Lake buyout coming to fruition. With an RSI over 82, it is heavily overbought.
Which means the medium-term horizon, really the next 3 to 6 months, hinges entirely on a binary outcome. Either a definitive acquisition deal is struck at a premium to today's price, or the upcoming August 27th earnings proved the Barretts completely wrong by showing massive organic reacceleration.
Yep. If neither of those things happens, the momentum fades, and gravity is going to take over.
It really is a fascinating case study in market psychology, which leads me to a broader thought I want to leave you with today. We're looking at a major established cloud pioneer where the stock was actually down 18% for the year, largely due to legitimate growth concerns.
Right.
Then a single rumor of a $43 billion buyout sends it skyrocketing to near record levels, acting almost like a smokescreen for the underlying business reality.
If we step back, it really raises a critical point about the current market environment.
Exactly. With the broader market indexes hitting record highs, you have to wonder how much of the tech sector's recent success is being propped up by the hope of massive acquisitions, private equity bailouts, and AI buzzwords, rather than actual organic accelerating business growth.
It's a great question. If a mega deal like Silver Lake falls through, and the reality of slowing growth sets back in, how many other Ferraris parked in the tech sector's garage might suddenly get repossessed?
It's definitely something to carefully keep in mind as you look at the valuations in your own portfolio.
Absolutely.
Well, that wraps up our look at Workday for today. Please remember to subscribe if you haven't already.
And definitely don't forget to check out that StockOracle 14-day trial link down in the description. It's a great tool to have in your corner.
Thanks for listening, and we'll see you next time.